Okay, I'm just repeating something which we did yesterday. Okay, uh, I'm just teaching again the slide. So some of the students were not there yesterday, isn't it? How many students have joined today? Just raise your hands. Lots of students. Okay, fine. So I'm just giving you a brief summary of what we did yesterday. But this is not the last time. Next time onwards, if you are there or not, I'm not, because the first time you were not there and this is the first class. So I'm just repeating a little bit. Okay, in 5 minutes, what we did. So the subject is financing large projects. Okay, so that's a subject what we are learning. That means how we finance particularly large project which involves thousands of crores. Okay, it can be a solar project, it can be a highway, it can be a metro. Fine. So we are going to understand those kinds of projects. So a large scale project is, just have a look at the screen. High upfront capex. That means you're going to spend a lot of money at the beginning. Then it has a long construction period and long operational period. That means it's going to last for long, 20, 30, 40 years, the output will be produced. Then there are multiple stakeholders in this project. Okay, we are going to discuss that more. And there are predictable long-term cash flows. Now, unlike the other projects, here you have predictable long-term cash flows. The company is going to generate cash and the lenders are happy about it because they are ready to finance such kind of projects which have kind of a cash flows, predictable cash flows. How they are predictable? Because some agreements are done with the customers, off-takers it's called. So off-taker agreements are done like power purchase agreements. Okay, like when there's a toll which starts, then they stop. They start collecting the toll, so they're assured revenues to those kinds of projects. Okay. So the examples are basically a thermal power plants as well as solar, wind, and water power plants. So these are the kind of examples. Okay. Then we have highways, airports, ports, metros. Then we have oil and gas fields projects. Then mining and industrial parks. Okay. The parks are basically developed by the state or the government. It has all the facilities. They allot land, ask people to come and start their projects. So there is power there, internal roads are there, water supply is there, water treatment plants are there. Okay. Then security is there. Okay. Now, this is very important. So I'm just going to spend some time here and then we are going to start from where we left yesterday. So it's a high capex, we all know. Long gestation. That means it takes about 2 years, 3 years to produce those kinds of assets. And then they run for about 20 to 40 years. And then all this is done through a special purpose vehicle. So SPV is a very important concept in long term in this large projects, because the company, the new company is formed by an existing corporate and it's called SPV. Okay, it's a limited liability company, and all this company is basically, all the project is executed via this company. Okay, fine. It is different than the company's main other units and companies. Okay, this is a separate company, and this company takes up the this thing project and makes those assets. There's a non-recourse or a limited recourse, which means that the debt the company is going to take, the SPV is going to borrow money and start a plant or a kind of a facility or asset. Now that as company the debt is going to be paid mainly from the project cash flows. New companies formed. The people who started promoted, they are going to take a loan from the bank. Okay. And all the cash flows which are going to be generated from the project will meet out the debt requirement. Okay. And it is done in an SPV form, a separate company. And there is a non-recourse or a limited recourse. Okay. Which means non-recourse means lenders can be repaid only from the project cash flows and assets, not from sponsors' other assets. Fine. So this is a separate company. So if this company is doing well and they have already made agreements, and whatever revenue they are getting, all the loans are getting repaid from there. So the lenders can only have recourse towards the assets of this company, and they can they get their loan repaid from the cash flows which this firm is going to generate. Okay. Now, the most important thing is that risk is distributed through contracts. Now, here, normally, business is always risky. We all know that it's not easy for the business to make money. But here, most of the risk is distributed. It has been taken care. Okay. So the lenders are very happy because if there is no risk in a business, then the revenue streams are very, steady. Then, they can lend and earn money from such kind of a project. So in project finance, each major project risk is allocated to the best party best able to manage it. And this allocation is legally enforceable through contracts. So there are various contracts which have been made by the company and various other stakeholders. Okay. And the risk is, shared. So, let's understand what kind of a risk the company can have, a new company which is formed under this. First is a construction risk. Whenever a new plant or power plant is set up or new, bridge or metro is set up, so there is always a construction risk. There can be delays, okay, cost overruns. So, risk, cost overruns, delays, poor quality. Okay. Now, if any such thing happens, then the contractor who has been allocated to do this job, who's called the EPC contractor, engineering, procurement, and construction company. Okay. So they are responsible for the project. And if the project is not being done properly and if there is a loss, then the EPC company takes the loss on their shoulders. They have to take care of any kind of a loss. Now, one of the major EPC companies is called Larsen Tubro, who does this job. It's the biggest EPC company in India. And there are 116 companies who are listed in the stock exchange for this job. Okay. Of course, there would be many more. So if the construction is delayed or the costs rise, EPC contractors bear the risk and not the SPV or lenders. Okay. So there will be no loss to the SPV because all the loss occurring because of, such kind of a thing, then it will be, paid by the EPC contractor. And the lenders also don't have to bear such kind of a loss because the EPC contractors are going to take care of that. Okay. Then, if you, last time in the class, I showed that, about the company called Larsen Tubro. So there's a site screener here. So where we, we went to Larsen Tubro and saw some financials of Larsen Tubro. And if you look at the peers, which means all the other companies which are of similar type. Okay. So the Larsen Tubro is the biggest company, which has a market cap of 5,64,000 crores. And then we have Rail Vikas, NBCV, IRB, Kalpatru, KEC International, Ilcon, and there are many other companies which are not coming here out, but there are about 116 companies which are listed in the stock exchange. Okay. So then we come back to the slide. So then we come to the operating risk. So the other one is after the plant is set up. Now the plant has to run. It has to produce the output. Okay. Now there would be some kind of operational risk. Like, the plant is not fully functional or there is a lot of, downtime, is facing issues. Plant is not running for full capacity. So any kind of a loss arising will be met out of the operation and maintenance contractor. So there are O&M contractors who are going to maintain this plant. Okay. They are going to guarantee this plant will be run at a capacity or a downtime which has been, agreed by all the sponsors and other people. Okay. So poor performance, high operation cost, downtime. If the cost is higher than what it was originally thought, then the loss will be borne by the O&M contractor. Then the downtime, the agreed downtime, if it is, not functional beyond a certain time, then any loss accruing because of the higher downtime will be borne by the O&M contractor. So O&M contractor is going to bear the risk. Okay. Now, stable, which means the operations will be stable. Okay. Predictable cash flows will be there because of this, and lenders will be comfortable to lend such kind of a project. Is that okay? Then we have the revenue or the demand risk, because whenever you're in a new business, now who is going to buy your product? Is there enough demand? Okay, all the time you will be able to run the plant at a full capacity. Now that all is not here present because this has been allocated to the off-taker, to the customer. They are already customers. The agreements which have been done with the customers, okay, for buying their output for the next 30, 40 years or till the time the plant runs. Okay. So in form of purchase power agreement, PPA. Okay. Revenue becomes contracted, not market driven. So revenue is basically, set by, by these agreements. So the lenders know that this, plant will be, after it becomes operational, start producing revenue and profits. So the project finance risks are not avoided. They are contractually reassigned. So contractually, they are passed on to various bodies and the demand risk is also not there. Then we have the financial risk. Okay, so here I'm going to spend some time. Last time what we did, and I just wanted to I mean redo this because I have added some numbers here. So this is basically the financial risk, inability to service debt. Now if the company has taken a loan, then it is not able to service the debt. So there is a financial risk allocated to sponsors limited and lenders structured. That means the sponsors, they have put in their equity, this thing. So there is an equity and debt both. So they have liability. What maximum they can lose is the equity what they have given to the company if the company is not able to perform well. So they have a limited kind of a risk only, which can they lose. The maximum they can lose is whatever capital they have brought in. And the lenders, it's all structured. Now, why we say structured? Because it is done through with the processes like the debt sculpting, designing the loan and principal repayment schedule so that the debt repayments closely match the project's expected cash flows, ensuring a stable DSCR, DSCR, debt service coverage ratio, okay, over the time. Fine. So if you look at the bottom, the sponsors, their loss is usually limited to their equity investment. Banks take the risk but protect themselves using debt service coverage ratio, LLCR, which is the loan life coverage ratio, and reserves and covenants. That means the agreements which the company has. Okay. So first let's understand a few terms. The first term is called the DSCR, debt service coverage ratio. The formula is like this, which is the cash flow which the company is going to generate. Okay. The operational cash flow, which is called CFAX. Cash flow available for debt service. Okay. I'll tell you how it is calculated. We'll do some question today and a class exercise also. And then we divide this by the total debt service, which means the principal plus the interest. Okay. So suppose the company is having a cash flow of 100 and debt service is say 80. So it will give you a figure of say 1.2, for example. Okay. Fine. So that means company is able to produce more revenue or more cash flow than what it is supposed to pay both in terms of. So this figure normally, should be around 1.3 for solar projects. Projects which are of solar power projects, normally by, understanding goes, the bankers prefer a debt service coverage ratio of 1.3. If the power, if the new business is coming and meeting 1.3, then they finance. Okay, fine. And based on this debt service coverage ratio, that loan is decided. How much loan the company is going to get. Okay, and how much it is going to get repaid. How it is going to get repaid. Okay, so that's called the debt sculpting. Okay, fine. So first, let's look at these terms. So DSCR, debt service coverage ratio, which is the CFATs, which is cash flow available for debt service divided by the total debt service. Okay. Now it has to be measures ability to service debt. Lenders typically require 1.2 to 1.3. Basically, it's for the solar kind of projects. If it is other projects, then if the business is more riskier, then they will go up to 1.4, 1.5, 1.6. So they will have, the company should have more cash flows. Okay, fine. So CFAD is cash flow available for debt service. Now, how it has been calculated? EBITDA minus the taxes, minus the maintenance, minus the maintenance capex, and minus the working capital requirement. Okay, so the starting point is EBITDA. Okay, we all know what is EBITDA: earning before depreciation, interest, and taxation. So what we minus is taxes, whatever the taxes the company is paying, minus the maintenance capex. Now look at a solar project. Okay, a solar project would be like this. Okay. So if you look at this diagram here, so what we'll have? The solar panels. Okay. Then we have the inverters. Okay. So if you look at that, the solar panels convert the sunlight into a direct current path, DC. From DC, we convert into AC, alternate current, via use of inverters. And then they are metered, how much units we are producing, and then it is passed on to the grid. It's a very simple process. Okay. So the main equipment would be the solar panels, the inverters, and some meters like this, and some electrical and some other civil. Then you require a land for putting the solar panel. So this is all the capex which the company is going to spend. Now the maintenance capex would be basically, after some time the solar panels to be replaced. Okay, after 5 years, 10 years, so they can be damaged to solar panels, so they have to be replaced. Or the inverters become old, so they need to be replaced. So this is maintenance capex. Okay. Suppose the plant is of a capacity of say 500 megawatt units, it can produce, and we have put all the things. Now it can run for next 20, 30 years by changing all these things which are getting obsolete. Unless we have to add capacity, then we have to need a further capacity. So that can be done through a separate SUV and a separate project. But this project requires only maintenance capital, nothing else. So which means that the CFAT will be what? Basically, EBITDA minus the maintenance capex, minus the taxes, and then minus the
working capital.
now working capital. Okay. So let's come back to that. Now, what is working capital? It's a very simple question. I think most of you have now done it many times, and some of you are accounts and finance students. Okay, you have that for this thing. So, what is a working capital? What is working capital? Anyone? Working capital
is the amount that the company needs for the day-to-day purpose.
Oh. So this is a typical definition which I get from any college, any university I go. Okay, this is okay, fine, nothing wrong in it. But to understand what is the real meaning of working capital, I'll just give you an example. Suppose you go to a showroom like Marks and Spencer showroom, big showroom. Okay, so you enter the showroom, you'll find a lot of items are there. A lot of things are displayed. They have kept a lot of stock, inventory, shirts, trousers, all those things which they are selling. They are all inventory of the showroom. So if you ask them how much, what is the value of that inventory? So they say that it should be around 5 crores. So that inventory which is lying in a Marks and Spencer showroom is nothing but inventory. It's a working capital. Apart from when you do a business, you require fixed capital. You buy equipment, cars, machinery, whatever, and then you require a working capital to run the business. Working capital is nothing but one form of working capital is inventory. Okay. Without inventory, you can't run the business. Okay. Now, as the business grows, the inventory can also go. So working capital, now you have 4 crores of inventory. Suppose a company, has 2 showrooms now, each having say 5 crores of, material there inventory. So working capital has gone up by another 5 crores. So that money goes out of the company. So there's cash outflow. So, and if, the business goes up, for example, some businesses are seasonal in nature. So winter comes, they have to stock more. So working capital requirement goes up. So it goes out of your cash EBITDA minus the working capital change. So working capital change will be in form of either inventory or in form of receivables. When you produce goods and sell them, it's not always that you're going to get money immediately. Okay. So you give 1 month credit, 2 months credit, 3 months credit. So whatever is stacked up in form of your receivables which you have not collected will be your working capital. So all the time when you do business, inventory plus the receivable becomes your main working capital. Okay. It's called the gross working capital. Then you make some deduction out of that. Because now when you are taking credit, you are giving, you are giving credit to your customers. So you are also purchasing a lot of things as your raw material inputs. So you are also blocking the money of your suppliers. So that is your current liability. So some part of your working capital gets financed to your current liability. So the net is called the net requirement of working. Okay. So that money always remains tied up in your business. It can go up or go down. As the businesses go up, the volumes go up, the working capital requirement will keep going up every year. The incremental change is called the delta working capital. Right? Normally, this figure is minus. It is added when you are contracting the business or When the seasonality is over, the demand comes down, then your receivables, your inventories fall, so it will give you a cash surplus. Okay. Like for example, I gave an example of Marks and Spencer. Suppose they have 5 crore inventory. Now most of the people now are buying all the goods from online. So gradually, the inventory is the stores have been shrinking. So they had inventory 5 crore. Now they maintain only 2 crore inventory. So 3 crores they have sold, generated cash, working capital coming down. So that has been added to the cash flows. Okay. Right? So the working capital can either go up or go down based on the changes in the working capital requirement. Is that okay? Is it clear? So the working capital is to be minused or plused, as maybe we have written minus here. Okay. Then we have the debt service reserve account. Okay. Now I would have explained it a little later, but now I'm going to just do it now. See, what happens is that some of the lenders, they insist that by the end of the beginning of the year, the borrower or the SPV or the borrower itself, they have to maintain some cash reserve equivalent to 6 months next 6 months installment. That is the interest plus EMI. So interest plus the principal, they have to keep in a separate bank for the next 6 just before the year begins, and that's called the reserve. So that the next 6 months the company doesn't have to bother. The borrower knows his money is safe, it is lying in a separate account which the borrower cannot touch. So it is called debt service reserve account. Cash reserve equal to 3 to 12 months of debt service acts as a liquidity buffer for the lenders. So lenders insist through the agreements that at the end of each year, the company has to maintain some cash reserve, which they can't touch. In the balance sheet, it will be shown as a cash and bank balance, but they say this is the only person who has got rights to take it is the lenders, and they can't use that cash. Okay. So sometimes they maintain these kind of agreements to ensure that there is no just as a security. Okay. I think I've missed out. Okay. So here we are. So then we come to basically the debt sculpting. So debt sculpting is the process of designing the loan repayment schedule, principal plus interest, so that the debt service closely matches the project's cash flow profile while maintaining the target DSCR throughout the loan life. Okay, just read this. So what does it mean basically? Basically, you are trying to find out how the debt should be repaid. Okay, how should be the principal, how should be the total debt service should be designed so that it is able to meet the lender's requirement. Okay, they will be able to, here we size that loan. First of all, we calculate maximum how much loan can be given to a project. Number two, the second process is called the debt sculpting, which means how the debt is going to be repaid, how we are going to design the principal and the interest. Okay, by keeping the debt service coverage ratio throughout the life of the loan life as something which is acceptable, which is 1.3 or some whatever. Okay, so the DSCR throughout the loan life. Now, what does it mean basically? So this is the DSCR. DSCR. So this is basically the cash flow divided by the total debt service. Now this is for the year 1, year 2, year 3. We can calculate separately. But suppose if you have to calculate for the whole loan life. So what we'll do? We will take we'll do it like this. We will calculate the present value of all the cash flows which the company is going to generate through the through the loan life. Suppose the company has taken 10 years loan, 12 years loan. So in those 10 to 12 years, how much cash flow or CFAT the company is going to generate. So we calculate the present cash flow. We calculate the present value of those cash flows and also calculate the present value of the total debt service. And then we divide and calculate the DSCR. It is called the loan life DSCR. Okay, fine.
The loan interest starts after the planned commercial operation.
Yeah. So let's see. Let's understand that. I'll just show you the Excel sheet again. Okay. Then I'll show you in a way so that now you understand, because last time I was little bit, I thought I'll do it later, but what I have done is that so many of you were there when I presented this. So, but I'm now going to do it in a proper manner so that you understand a little bit much better. So this is a model. Okay. How the companies, this model is used by the banks to find out what is the maximum amount of loan which can be given to a particular project, number one, and how the loan is going to be amortized. Okay. So that the company is able to pay the loan comfortably during the tenure of the period of the loan by maintaining the debt service coverage ratio. Okay. So that is the whole idea. So now, so it has certain columns which are mentioned in blue. So where we have to feed them. Okay. So these are things which we have to give. Then ultimately we'll get the debt amount. Automatically we'll get the debt amount. How much debt amount can be given to this company. So first, debt tenure. So we have chosen 12 years in this example. This is an example. So I put 12 here. Okay. We can change this. Then the rate of interest is 9%. So the lenders, they want 9%. Okay. Then the target debt service coverage ratio is 1.3. Okay. So banks want 1.3. We can change this and we can have a different figure. We'll do that. Then the discount rate, that means the loan rate at which the bankers are given the loan, that will be used as a discount rate because that's the cost of your debt. Okay. So we are going to use that to calculate the present value of the cash flows and the present value of all the debt, total debt service. Okay. Now this figure, if you put this number, this figure will automatically be calculated. Okay. But we'll come to that. First of all, the first is the CFATs. That means the cash flow after available for debt service. So which is given as these numbers for the 12 years. Okay. Fine. You can see the numbers. 30 years, 30 crores, 32 crores, 34 crores, like this, up to goes to 40. It's, it goes up more as the number of years pass. Then the debt sculpting. Now this figure, opening debt, will get automatically populated from the first sheet. After we have put all the parameters, this figure will be picked up from the first sheet. Okay. It is appearing as 197 at the moment. So it is picked up this. Will change, it will get changed. Okay. Then first it will be interest calculation. Interest is how much? Loan is how much? Loan we know is, so loan is 197 crores. Okay. So the interest rate we know. So multiply the interest rate, automatically it calculates from the input B4. B4 is the rate of interest 9%. And B3 is the loan amount this. So it picks up interest, and then the total debt service. The total debt service is based on this DSCR ratio, DSCR ratio. So it has been calculated on that basis. Okay. That means the cash flow divided by DSCR, we arrive at the total debt service. So Excel driven, it has been calculated. Okay. Then the principal is the balance amount, because we know that this much of interest has been paid and total debt service is 23 based on the 1.3 ratio. Okay. So principal is 5.3. Okay. So closing debt is this. So it keeps working like this, and you'll find ultimately the debt has become zero. And the DSCR ratio has been maintained at 1.3 throughout the loan life. Is that okay? Fine. So then we go to the loan life, how it has been calculated. We'll do that. So what we have done is we have taken the cash flows for all years. Similarly, we have taken the debt service, which has been picked up from the previous sheet, and then the discount factor, which is the cost of debt, and calculated the present value of the cash flows as well as the present value of the debt service, and arrived at this loan life debt service coverage ratios. If you look at the formula here, so it will be like this. Sorry. So it is like this. Okay. So which is basically you use the discount factor, you discount the present value of cash flows for each year, divided by the present value of debt service, total it up, and divide the present value of CFATs by the present value of debt service, which will be this thing. So this is sum of E3 to E4, everything divided by all this. So we get 1.3. Is that okay? Fine. So I just remove it. Then we go to the final sheet, which is the ultimate result which gives. Okay. And then we'll just try different numbers to see how it works. Now, so that means the debt size is 197 crores. This has already been done. The debt was zero at the end of the 12-year period. Then the DSCR is 1.3. The closing debt is zero. Now this figure should be always zero. If this figure is zero, that means you have done the job. Now, if this figure is not zero, then you need to work it out. Okay. So let's go to the CFATs here first of all, or let's go to the inputs. Okay. Here I've chosen 1.3. Okay. I'll change this. I'll make it to 1.5. So what will happen? The loan will go down or go up? Go down because the bank has become more stringent. It wants more cash. Okay. So if I put this, the loan figure has not changed. Okay. But it has to change. So let's go to the debt goes to the debt sizing here. You will find there's zero is not there. So that means we have to make it zero. Then only the new loan will come there. So what I'll do, I'll go to the data, go to what if analysis, go to goal seek, and make this figure as zero. Okay. And it is dependent upon the first number, which is the input, which is the loan. Okay. And then say okay. So now it has become zero. So now we can go and check what is the loan which can be given. So if we go to the loan, it has become 170 crores. And if you go to the debt sculpting figure, so it has become zero. Okay. Is it okay? So that means we can change anything you want. We can change the CFATs, we can change the debt service coverage ratio. We can change any kind of a thing, and it will automatically, the debt will be sized and the debt will be sculpted. Okay. And you can see the debt service cover ratio is maintained throughout 1.5. Okay. All the figures will change automatically, and the loan life debt service cover ratio is 1.5. Okay. So similarly, you can change the rate of interest at 8%. Okay. So you will go to the debt sizing, you will find the figure has changed. Okay. So here also you can go to the what if analysis, go to goal seek, and go to this, make it to zero, and based on what number will be the input. So it has become zero. Now we can just go to the inputs and see the new loan. So rate of interest is less now. So loan will go up. Fine. Is that okay? Clear? Okay. So let's come back to the slide again.